Hey guys, welcome to the Bright Penny channel, and today I'm going to be giving you guys general tax advice for forex traders all over the world. Let's get into it. In this video, I'll be covering the following: how income tax works in general, what to look out for when dealing with the taxman, how to structure your trading to benefit from tax planning. So as I'm preparing this video, just know that guys, I am not thumbsucking this information. I am an actual accountant. I own an accounting firm, online accounting firm, and we provide services for businesses as well as individuals. So guys, please be aware of that, and remember, everything that I do is to create awareness. For specific advice, please get in touch with us. Remember, this is the free resource as you're watching right now this video. However, if you get in contact, you will be paying consultation fees because now I'll be dealing with you directly. But other than that, make sure you deal with competent and applicable or capable professionals. So I'll be giving you guys general tax advice for retail forex traders. It's very important that you guys be aware that as a retail trader, you're actually operating in your personal capacity, and what this exposes you to is the highest applicable tax rate possible, and this is something that applies all over the world. So in terms of getting into specifics, once again, this is a general advice video, creating awareness and making you guys aware of exactly how you can actually maintain your tax affairs as a retail forex trader. How tax works in general. Every country needs funding in order to maintain government spending and various public expenditures, and the main way of funding for governments is through the paying of taxes by taxpayers. There are multiple forms of tax types. However, in this video we will be focusing on the most relevant tax type, and that is the income tax. Income tax is generally calculated based on the income generated by people or entities of a particular country within a 12-month period. This period is often referred to as the financial year. Income tax is calculated based on all income generated less allowed deductions to determine your taxable income, and then applying the applicable income tax rate. What to look out for when dealing with the taxman. As previously mentioned, you can get taxed as an individual or an entity. As a retail trader, you trade as an individual, and the profit generated is taxed according to the applicable individual tax table within your country of residence. Unfortunately, being taxed as an individual results in paying higher taxes. Hence, when running a business or operating a side hustle, it is better to do it as a registered business in order to benefit from business tax rates. So, is there a way to get better tax rate as an individual, and if yes, then how? The obvious answer is yes. The how is by structuring your business by registering it as an actual official business and trading as a sole proprietor. The concept is to register as a business where you own and manage it predominantly by yourself. The main advantage here is you can benefit from being taxed as a business while being an individual. Remember to subscribe and turn on the bell notification, as I will be breaking down the pros and cons of trading as a sole trader. Look out for that video. How to structure your trading to benefit from tax planning as a sole trader. Structuring your finances is better done with a professional like an accountant, tax practitioner, or financial advisor, whichever works best for you based on your financial level and needs. On the other hand, if you choose to do so, it is also possible to structure your tax planning yourself, provided you have the sufficient knowledge to do so. It's really up to you after all. Proceed at your own risk. Step 1. Capital versus income. Income tax is based on income generated. As a trader, you make money from money, and this can confuse traders that don't know the difference. The money you deposit into your account for trading purposes is regarded as capital of nature. This means it is not subject to taxation, as you will be using this to generate profits, which will be later taxed. In some countries, pre-trade expenses can be deducted against tax owed, and your capital could be deductible if this is the case in your country. Step 2. Financial management. Every business has either fixed and or variable costs that run the business day to day and year on year. It is therefore important to track and record these expenses in order to ensure that information is well organized and ready to lower your tax liability. The most important report you need for managing tax is the income statement or profit and loss statement. Its structure is typically like this. We begin with income at the top. So as a forex trader, your income can come from profits and losses from trading activity. That's the normal bread and butter. You make profit, you have to put it on here. Remember, not what you put in, the profit that you actually generate, and the net profit, because I mean, as a trader, you do experience, gains and losses. So within a given month or within a given period, that net gain is what you put here as an income. Other forms of income as a trader is when you are trading on behalf of others and you guys have some sort of a revenue split or whatever case may be. In this case, to simplify things, we'll think of sort of like a profit share model whereby you guys agree on a certain percentage as you trade on behalf of some of your clients comes to you. That will be revenue that you put down, and on the converse side, or conversely, the amount that you pay to your client, that's going to go to your cost of sales. In other words, any other income or any income that you are generating within your business, you have to add it here. After adding your income, the next thing that we'll be looking at is cost of sales, purchases, or service costs. So here we're looking for expenses directly attributable to the income that you generate. So whatever money that you make, there is a cost to it. So that cost is what we put down here. So generally the cost that you put down here is obviously, as I mentioned, profit share from account management activities, the outflow to the client. Conversely, as I said previously, the amount that comes to your business, that's your income, and the amount that you need to pay out, that's your cost of sales. And that amount you can actually get it back in terms of claiming it as a direct cost. Other costs will be platform costs, brokers fees, swap fees, etc. Also any other costs. Remember guys, this is why it's so important to use a professional, because when it comes to attributing costs and making sure determining whether they are directly attributable or indirectly attributable is very important, because those distinguishments a professional can effectively assist in making sure, after understanding how your business works, that these costs are actually placed at the right place or categorized correctly. So that's a very important thing, because it can be the difference between saving on taxes or paying more. Then after finding out the service costs, we're going to be moving on to gross profit, and ultimately we get to our operating expenses. Here is a list of typical expenses that you would usually encounter as a trader: subscription services, advertising, rent, interest on a bond, interest expense, repairs and maintenance, phones, internet and stationery, office expenditure, rates, taxes and municipal service charges, utilities, and lastly, other expenses related to trading purposes. So once again guys, this section is called operating expenses. So here you're going to add each and every expense that you actually incur within your business that is not necessarily directly attributable to the income, but is subject or is paid out through your business operations. So all other expenses are included here. So once again, it's very important to know what type of expenses are actually allowed, because we're not looking at things that are capital of nature. So an example of something that will be capital of nature is if you buy a machinery or if you buy a car, this is not where you put it. Now, Once we have considered the operating expenses, we arrive at our operating profit, or earnings before interest, tax, depreciation, and amortization. At this point, we're going to be subtracting depreciation or wear and tear. This is an expense that is not a cash-based expense, but is an expense in terms of calculating usage of a particular asset. So as a forex trader, sometimes you might have some sort of a robot that you purchased. That robot is an intangible asset, and its usage can be amortized in terms of depreciation, or there's an amortization expense, and that amortization expense, when calculated correctly, can be added here as a deductible. Once again, doing these things in a professional manner can allow you to be able to gain additional deductibles in terms of your tax liability. So at this section, we had whatever depreciation that is extracted from all assets owned in terms of the company. Then after you've considered your depreciation and wear and tear, we arrive at earnings before tax, or taxable income. This is the magic number that we are working towards in order to determine the actual taxable income, whereby we apply the applicable tax rate onto this taxable income. Remember guys, there's a difference. So when we are calculating for tax, we start off with our income. Our income is not necessarily our taxable income, because it has to consider everything that we have mentioned before. So at this point, we have considered everything. That's how we arrive to a taxable income. Now at taxable income, you apply the necessary tax rate according to your country. Then once you have that, you have your net profit or loss. Your net profit or loss is the amount of money that belongs to the business. Often it's categorized under retained earnings, and this is where you can do whatever you want to do with your business, because you've effectively obliged or responded to your tax obligation. Step number 3, reporting. Maintain accuracy. Ensure you categorize your trading profit and loss information on a month-to-month basis, and also pull an annual report matching your business financial year. These records help to ensure you can back up the submissions that you will be making to the taxman. Once again, making sure your administration is up to point is very key. Once again, this is where a professional can effectively help and make sure you do your things right, maintain accuracy, and things being done in such a way that your taxman will not have any additional queries, because the queries cost time causes money. So we want peace of mind to make sure everything is done correctly the first time. So once again, right planning can assist in terms of managing, monitoring, and end up submitting your tax returns. So make sure you get in touch with us so that we can assist accordingly. Conclusion. Managing tax as a forex trader is all about distinguishing what is capital and income of nature, and thereafter determining the relative expenses that help to lower your tax liability as much as possible. Please remember to subscribe to the channel, as I'll be making videos like this to optimize your business and entrepreneurship journey. Also join us on Patreon to make specific requests like tax planning for your business type based on the country you are from. Yes, I can do that, but I need you to tell me so that I can deliver. So guys, really hope you learned something. I prepare these types of videos to really help you guys out. So guys, please look out, and also comment down below letting me know what other topics of interest that you might have, so that I can assist you guys swiftly. Other than that, hope you learned something guys. See you on the next one.